Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we focus on the main events driving currency markets this week and in the week ahead. Today, I'm joined by Robson, who is our co-head of G10 FX trading based here in London. And we are discussing the Bank of England rate decision, which was definitely the focus for this week, and expectations were high considering UK inflation sort of less than expected going into it. But maybe a bit of a damp squid in terms of the market reaction. Paul, what were your main takeaways from today's decision?
Yeah, I completely agree with you about it was a little bit of timid reaction, certainly in FX markets and also in rates markets as well. So maybe there wasn't a huge amount of new information in it, but I think there was clear risks that there was going to be a sort of dovish pivot from the Bank of England. And I think market sentiment was that way as well. And I think the key takeaway is that we really didn't get that. So in terms of the decision, we got the quarter point hike in rates, which was already fully priced by markets in line with our own expectations. The vote count 7-2 for raising rates, 2 dissenters for unchanged rates. That was also in line with expectations. But this meeting was always going to be about the guidance, about the sort of hints from the MPC about where rates might be going in the future, because that's ultimately what's going to be more important for the market reaction. And in terms of that guidance, it was almost a carbon copy of the previous meeting. And I think actually relative to market expectations in terms of guidance, that played a little bit hawkish. So this idea that further rate hikes might be needed if there were signs that inflation had been a little, or turns out to be a little bit more persistent. So the outlook for policy here in the UK is still very much data dependent. I guess that's always the case for central banks, but central banks, ECB, Fed are just taking it sort of 1 month at the time, because we are at sort of close to peak rates or inflection point in policy. And for the Bank of England, they're probably quite confident inflation is going to come down, because you've got the sort of cumulative impact of all the other rate hikes that they've delivered, which aren't actually impacting the economy yet, because people take time to sort of remortgage and filters into sort of the effective policy rate. And we are moving into a very interesting sort of 3-month period where a lot of those sort of 2-year interest rate mortgages are coming up to be refinanced. The headline inflation on our forecast thinks it's going to go lower as well. But for now, I think the slightly sort of hawkish guidance relative to dovish price markets, not in terms of rates, but in terms of the guidance, that was the key takeaway for me today.
Okay, so still a hawkish outlook for the Bank of England. I mean, what do you think are kind of the main drivers, or what are you looking for in terms of kind of sterling's broad reaction from here?
Well, over the last couple of months, sterling has moved with interest rate expectations. So I referenced sort of 2-year interest rates between, say, the US and the UK, or the UK and Europe, and that still matters. But there are some other, I think, key drivers for saying that people have to be mindful about, and they're sort of turning a little bit more positive for the currency. Obviously, we've talked a lot in the past about some of the risks around the UK outlook, and that maybe markets had to revisit their excessive pessimism in our view, and that's what they've been doing. But some more recent events, so this sort of banking sector instability in the US and in Europe, the UK has almost been like this island of stability in terms of that. And when people are a little bit more fearful, if they are fearful about the banking sector, maybe UK assets are suddenly looking a little bit more attractive. We think balance of payments trends is underappreciated in terms of sterling market. So energy prices having come lower, we think the trade deficit is going to narrow. And if growth expectations continue to drift higher, then that's a better combination of how you fund the deficit, because stronger growth, even though the baseline is pretty weak, will attract more capital into the UK. I think the weakness in global manufacturing is also important for the UK, because here in the UK, we have a much more sort of service sector dominant economy. And that's the part of the global economy that's doing well. So we're sort of less impacted by weak manufacturing, helped by the service sector as well. And the final point, just this idea that you're getting positive data surprises here in the UK relative to the US, relative to Europe. And while that continues, we're happy to be looking for further gains for sterling against the major currencies.
Yeah, I think that's a key point that, it's all relative to expectations. And I guess expectations were quite low when it came to the UK. We had quite a bad, investment perception. And I know you were quoted in the FT talking about that kind of change in sentiment when it comes to sterling. Where do you think that change is coming from?
Well, I think it's just the better than expected growth outlook in the UK. I think that's one of the key drivers. As I've mentioned previously, the baseline for the UK is pretty weak. It's not great, but the change in expectations is positive. I would say the delta on those growth forecasts is positive. So we came into the beginning of the year and looking at the Bloomberg consensus for UK growth this year, but it was actually going to be negative. People were forecasting a 1% drop in GDP here in the UK. And on the latest numbers, it's just below zero. And in fact, the Bank of England today, they revised up both their inflation forecast, but also those growth numbers. And so I think markets are having to revisit what was previously a very sort of pessimistic baseline for the UK. And I think that matters. I think that we've talked about the risks around the UK. Remember, I think you mentioned them last week about the dogs that didn't bark, and we continue to see those. And I think other people have come around to the idea that those risks have sort of gradually been ticked off. They're no longer a risk to the outlook, or certainly the probability of them impacting has been reduced, and that the outlook for the UK and sterling looks a little bit better. And I would also just say that maybe valuations were very low for sterling, and maybe they're just adjusting to more realistic levels.
And I know we've had this kind of frustratingly slow disinflation process here in the UK, but actually in the US, we got some better than expected number with a sharper than expected decline in US CPI. I mean, how does that place us in terms of our dollar downtrend view?
Well, we're still very much behind that sort of dollar trades weekly from here as the US economy becomes less exceptional. And the core view or key view here is that the dollar mainly underperforms against European currencies, where we see the sort of lingering impact of lower energy prices, seeing a shift in rate and relative growth against the dollar. So those inflation numbers this week sort of play to that view. So some of the headline numbers a little bit stronger than expected, but the details of the overall US CPI report, I think, were dovish. You also got some supporting references in the Wall Street Journal from someone who watches the Fed very closely, and it just plays to the idea that the Fed is done for now, at least, tightening rates. And actually, by the end of the year, our economics team think that they could be cutting rates pretty aggressively. And if you put that in the context of today's changing guidance, or the lack of changing guidance from the Bank of England, and then the ECB still guiding to further rate hikes, rate spreads moving against the dollar, I think is the key takeaway. So we're very much behind the idea of the dollar goes weaker. The other point that I'd like to make, and this is a point that my colleague Brian Dangerfield was making to me earlier in the week, and it's about the focus now is what kind of slowdown do you get in the US? Is it a soft landing or is it a hard landing? And this all plays to the idea of where you are on the dollar smile. So you can get a little bit weaker US data, and that's negative for the dollar. But if you were to get a real sharp slowdown in the US economy, it sort of starts playing positive for the dollar as sort of risk sentiment in markets starts to deteriorate. And at the moment, we're in that little sweet spot where the data are weakening, a sort of soft landing in the US, and the dollar goes down primarily against, as I say, European currencies, we think.
Well, definitely in the EM space, we're all hoping for a dollar downtrend. It just provides so much tailwinds for EM currencies. And, because EM economies are so much poorer. And because of that, in the CPI basket, energy and food accounts for a much bigger weighting. We've really seen inflation coming lower. But I think one things that kind of understill our positive EM view, is the fact that actually EM central banks have been very cautious. They don't want to incite currency depreciation pressures by easing too prematurely. Paul, thank you so much for joining us and giving us your take on the Bank of England this week. That's about all we have time for. So let me wrap it up there. If you did like our podcast, please do click like and remember to subscribe so you can get the latest episode first.